Founders often spend weeks agonizing over font choices and financial projections, but a venture capital meeting operates on a different level. Investors look past the slides to evaluate the human being sitting across the table. Top-tier venture capital firms review around 4,000 opportunities every year. Out of those thousands, they might fund 200, and ultimately, just 15 will generate nearly all their economic returns. That is an acceptance rate of less than 1%. Markets pivot, and new technologies become obsolete in months. Because the business environment is too volatile to predict with certainty, investors anchor their risk management on the person standing in front of them today. Internal friction kills more companies than product flaws or market shifts. Team dysfunction causes 65% of high-growth startup failures, making founder chemistry the most critical variable. With team conflict being the primary cause of failure, the pitch meeting ceases to be a presentation. It becomes a live behavioral stress test. To understand how this evaluation happens, we look to the work of social psychologist Nalini Ambady. During her PhD research at Harvard University, she studied how humans form perceptions of one another without speaking a word. Her studies on thin slicing demonstrated that humans observing just 10 seconds of nonverbal behavior can accurately read a stranger's competence and likability. Apply this to venture capital. The evaluation begins the exact moment a founder walks through the door. Investors subconsciously scan for specific signals. They evaluate for genuine domain expertise, clear communication skills, and the raw grit to execute. These traits form the basis of visionary leadership. VCs must determine if the person pitching has the capacity to see where a market is heading, long before the rest of the industry. Before an investor fully grasps the technical architecture of the software or the business model, their brain has already calculated a baseline assessment of the founder's capability. That initial assessment is heavily influenced by energy. Consider a case where a single negative behavioral signal caused a multi-million-dollar deal to fail right at the finish line. A fintech startup had sailed through its first 3 meetings. They were growing fast, and the financial due diligence was completely clean. The lead partner flew the founder into London to present to the entire fund's committee for a final vote. The founder delivered the exact same pitch with the exact same data, but his delivery was flat, and he operated at half speed. After he left the room, the committee voted to pass on the investment. The lead investor later discovered the cause. The founder was suffering from a severe cold that day. That temporary illness sapped his enthusiasm, costing his company $2 million in funding. VCs hear dozens of pitches every week. If a founder fails to project intense drive about their own business, the investors will mirror that apathy. In this environment, a bored investor is an investor who sends a rejection email. This is why successful founders often move away from the traditional presentation format. Engaging in an authentic back-and-forth dialogue outperforms a perfectly rehearsed 16-slide deck. In fact, investors intentionally interrupt a monologue. They derail the script to test a founder's cognitive flexibility and see how they respond to unexpected pressure. When they poke holes in the business model, they are watching the reaction. Does the founder get defensive? Do they crumble when their biggest operational risks are exposed in real time? VCs value vulnerability in these moments. When faced with a deeply complex or currently unanswerable question, a strong founder knows their own limitations. Admitting to an unknown builds immediate credibility. A founder who can say, "I don't know," signals a level of self-awareness that a rehearsed, risk-free plan cannot match. Abandoning a rigid script does not mean walking in unprepared. It means shifting preparation away from storytelling and toward an internalized understanding of the company's internal mechanics. This dashboard highlights the exact numbers investors scrutinize. They expect founders to recite customer acquisition cost, payback periods, and burn rate without looking. Beyond your data, understand the room. Research an investor's historical portfolio to prove your company aligns with their strategy. Surface-level memorization might work for a 5-minute demo day, but it will shatter under the weight of a 30-minute conversational stress test. Deep operational understanding is what sustains you. That depth of knowledge gives a founder the quiet confidence to remain flexible and engaged when a meeting unpredictably changes direction. The first VC meeting is a behavioral evaluation for a decade-long partnership. It measures your resilience and character far more than your presentation skills. Think of the pitch deck as a ticket to the conversation. Once the meeting begins, variables like judgment, credibility, and leadership determine whether that interest converts into capital. Before your next investor meeting, stop tweaking the slides. Master the core unit economics, the market data, and the risk mitigation strategies. To help you prepare, check out the VC Funding Blueprint Kit linked in the description. It includes a customizable Canva deck, an AI financial narrative engine, and a slide-by-slide psychology guide. Subscribe to the channel for more deep dives into startup execution, pitch deck construction, and investor psychology. Ultimately, investors are searching for a long-haul partner they can trust. They're deciding if you'll lead this company to the finish line.